The third section of this four-part series, which lasts about 25 minutes, discusses a number of factors and constraints that can affect financial structure planning. These include certain operational and economic factors, various legal protection issues, and a number of taxation matters.
Okay, what are some factors and constraints affecting your planning of the assets and the financial structure? I've broken that up into three pieces: operational and economic, legal protection, and of course taxation. The obvious first point, structure must allow the operating personnel's planned use of the assets. Okay, that's pretty basic. If they do decide, gee, we can borrow locally, then to provide a mechanism for local lenders to loan to the subsidiary and to try to keep cost of capital and interest amounts relatively low. So that's some general things that are going to be important. Legal protection, protect assets from creditors, product liability claims, nationalization by the host country. That's a general area. And the second point, protect intellectual property from theft. There's an expression in English you sometimes use, the elephant in the room. And there's this huge issue, this huge matter which people don't like to admit is there, but it's there, and it's sometimes referred to as the elephant in the room. Okay, the elephant in the room with regard to China is the risk of having your intellectual property stolen. An important aspect of planning involving China is what can we do both to physically protect intellectual property and legally protect it. See, what do I mean by physically? A lot of companies require their executives not to take their laptops, for example, into China, or to have special security software. Certainly in terms of work procedures within companies that are subsidiaries of foreign companies, there needs to be very careful policies on who gets to learn what and who has access to what things within the worldwide computer system of the company. This has been a major area. So physically, how do you protect the crown jewels of the company? And secondly, from a legal standpoint, how do you try to protect so you have the strongest legal protection? So anyway, that I don't want to belabor the point, but it's something to be aware of in the background as you come up with ideas. You need to understand that your client may be very concerned about this. Okay, and then taxation. I mentioned local interest deductibility. Generally, having debt is better than having equity because interest is deductible, dividends are not. Not only is there the tax aspect of debt, but is it easy to return capital? Let's say you have too much cash in a subsidiary. Is it easy to return capital to the shareholders? Can you just, if you have 100 of capital stock, can you just simply send the cash back and return, let's say send 25 of the cash back and reduce your capital to 75? Anybody familiar with their country's companies' laws regarding reduction of capital? Very often, there is a court procedure required before you can reduce capital. Well, why? Why is reducing capital hard, but just paying back the principal of a debt easy? If a company can easily return capital to the owners, the creditors are put at risk. If you look at the company's law of your own country, you'll probably see that there is a great deal of what I'll call creditor protection. The directors are not allowed to pay a dividend if it's going to hurt the ability of the company to settle its liabilities in good fashion. Has anybody ever looked at a partnership law? China has a partnership law now. Have you had the chance to read through it? Fortunately, it's not so long.
I have some basic ideas to which part you're referring to.
Well, okay, I want you to think. You've seen the Chinese Companies Act.
Yeah.
Okay, and you maybe to some extent have seen the Chinese Partnership Act. Does the Chinese Partnership try to learn how to speak. Does the Chinese Partnership Act have within it any of the creditor protections that the company's law has? Or is the partnership law silent and doesn't provide, in a sense, these kinds of creditor protections? For a company, if it's going to pay a dividend, the directors have to use good judgment. Can the company afford to pay that dividend? Yes or no? So there's a mechanism that the directors must act responsibly to protect the creditors. And the directors cannot have the company simply pay back capital. Again, there's procedures for that. But what about partnerships?
No, because they are personally liable.
Yeah, because the partners are personally liable. If the partners take money out of the partnership and put it back into their own pockets, the creditors of the partnership can still have a legal ability to go against the assets held by the partner. So you don't need, in a partnership, all of these creditor protections. So, there's some, in a sense, there's some logic as to what you find in these various laws in the various countries where you're from or that you're looking at through the assignment. There are some differences. And usually where there's a difference, always sort of sit back and say, well, why is there a difference? And that's a good example. Gee, we don't find creditor protections in a partnership law generally because there's unlimited liability as opposed to limited liability as you find in most companies. Okay, again, getting back to the slide, taxation, local rules on lease versus lease or license versus purchase, debt versus equity, thin capitalization matters, different taxation of interest and dividends in the country of the parent. That can be often the case. And required investment levels to achieve local tax incentives. Now, that's a kind of interesting thing where you in your assignment 4 are looking at a country which has local investment incentives, for example, a tax holiday, such as Thailand has. Well, very often there will be a requirement in order to receive the benefit of an incentive that you have to have total investment equal or greater than some minimum amount. If it's at this level, you get a 5-year holiday. If it's at this level, you get an 8-year holiday, or whatever the rules are. They can vary by country. If you recommend an approach where maybe you don't need to put the asset on the balance sheet, if that machinery is not on the balance sheet, well, maybe you don't have enough investment to qualify for the local incentive. So maybe you do have to have, in order to achieve this tax objective, you have to choose an approach which in fact will give you that large amount, which I think, what was it? It was the cost of the machinery in assignment 4 was, I think, 10 million. And the amount that would be charged for that machinery to an unrelated purchaser was, I think, 15 million. Is that right? Anybody remember that? Everybody sort of looks like this. Okay, well, anyway, I think it was something like that. Whether my numbers are exactly correct is another issue. But the point is that some approaches allow that machinery to be on the balance sheet. Other approaches don't. It's not on the balance sheet. And it may be very important to have it on the local balance sheet if the local incentive rules effectively require it as a condition to obtain the local incentive.
Professor?
Yes.
I have a question about creditor protection. So if I want to find the regulation that related to the creditor protection in my chosen country, so what the regulation should I look at? I know like maybe one thin capital.
Well, the thin capital is a tax issue. And thin capital, if there are local thin capital rules, you'll find in the tax law. The creditor protections, that's normally found in whatever law there is, usually called a companies law or companies act, under which sets out what types of companies can be formed. Again, for example, in China, the companies law provides for 2 types, one which is the joint stock company, one of which is the limited liability company. In Japan, there's the Kabushiki Kaisha, which is, in a sense, a joint stock company, and then Godo Gaisha, which is generally like a limited liability company. So you would find the rules of how a company has to operate. And those rules you would expect to find not only how are creditors protected, but governance provisions and other mechanisms by which the company is set up.
Professor, I have a question. So the debt capital ratio in the company law, in comparison with the thin capitalization, thin cap law, which the thin cap law should be more strict, or a higher strike?
Well, okay, you're bringing up something which is funny. In every other country, well, I don't know about every other country, but in all of the countries that at least I'm aware of are different from China in this respect. In China, there are investment rules which are not tax rules, which tell you for the amount of capital you have, how much debt can you have. Those are the investment rules. And as a result, for a given amount of capital, you know that you cannot have more debt than this amount. And it's important in China to, in fact, put that into your your charter documents for the formation of the company. It goes through an approval process. It's taken very seriously. And you have to have budgets to support why you need this amount of capital and investment. So there's quite an approval process. I'm not aware of any other country that has anything that is as serious as this. Normally, the company's law will just, say you form a company, maybe there's a minimum level of capital. I don't know about today, but years ago when I was in Japan, I think it was, I'm maybe forgetting, but I think for back then, for a Kabushiki Kaisha, it was either 10 million yen or maybe it was 100 million yen, something like that. And then a lower amount for back then the Yugen Kaisha, which was before the other one, before things got changed around a bit. But the minimum level of capital was not a tax law, but was coming out of the company's rules. But there's no, at least to my knowledge, certainly no limit on how much debt the company can have. It's just that the directors are supposed to act responsibly.
There's no limit to the Japanese.
I don't think there's any limit on how much. But in China, in U.S., there's no limit. Again, we're not talking about tax law.
Okay.
We're talking about the company's law under which a company operates.
In Chinese company law, we have, or it's just for foreign companies.
I'm pretty sure the investment rules are separate from the company's law,
Right.
and I do not know whether those rules apply only to foreign invested enterprises or whether it applies to all companies in China. I don't know. But it's always important to, in a sense, recognize the difference and to understand the aspects of both. In other words, non-tax law, what are the requirements and restrictions and so on. And then separately, okay, now we think about what there is with regard to tax rules. Is there a limit on how much interest is deductible?
Except China, in the rest of the world or many other countries, no such limit on the equity debt ratio in company law. But
generally, only in the tax rules.
Only in tax law. But in China, we have that limit in investment regulation, probably because China would like to lock your investment.
My impression, this is just the impression from being there and working with it. My impression is that historically, let's say, various governmental authorities at different levels locally, they want to know what's going on, and they want to approve or disapprove of actions that are within their area. So they want to know and approve how much capital there is going to be, how much the maximum debt is, and what the area of activity is that a company will pursue, and to approve that, and to maybe disapprove of something that they think shouldn't be done by this company.
What about Chinese tax law to this issue, to the fintech? So we don't have to have a tax regulation. We don't have.
There is a tax rule, thin capitalization rule in China. You would have to, apply both the investment company rules in terms of how much debt there can be, and separately, you would then need to look at the tax thin company rule to see if any interest is disallowed as a deduction.
This doesn't make any sense to use two set of limitations. Then just the more strict one counts. The other one is useless.
Oh, well, in a sense, yes, that's right. But that's, I don't know that I can immediately pull out examples from other places, but I mean, I'm sure there's many examples in law where there are two different restrictions coming from different authorities, and yeah, effectively the tighter one becomes the defining thing. But again, remember, the tax rule is not saying that you cannot have debt. It's just saying that if you have too much debt based on the thin capitalization rule, then some portion of your interest will not be deductible in calculating tax. You can still pay the interest. It's still legally interest. It's just that you won't get a tax deduction for the full amount of the interest. But it's still legally interest. Now, the investment company rules are limiting you and saying, okay, this is the maximum amount of debt you can have, and therefore the maximum amount of interest that you could ever pay. But it says nothing about whether it's deductible or not. So they're just two different restrictions.
So in U.S., the ratio will be 1 to 3, right?
Well, okay, now you're looking at what is you might call the U.S. thin capitalization rule. And it's been a while since I've looked at it, so I don't remember the specifics. But yes, there is some restriction on how much interest is deductible for a U.S. company that is paying interest to a foreign person who is receiving the interest.
Whether the thin capital rule is only for foreign investors, or
well, it depends on the country, but the normal intent is foreign because domestically the interest income will be taxable to a domestic lender within that same country.
There is the same restriction for domestic investors.
Well, it depends on country. Sometimes,
like in the United States, even in the domestic setting, a investor, there's a ratio that's like if you invest equity $10, then you can only borrow 30. If you borrow more, then the tax authority will consider that that's not real loan. That's your investment.
well, okay, you're right, but let's again do things more methodically. The issue first is, do you have a real debtor-creditor relationship, or do you have an equity thing? In other words, is an instrument, a loan in legal form, is that a true loan, or is it really just a form of equity? And that's the first question. If you decide that it is truly debt, then you go to the next step as your 163J, which is that rule you're referring to. Does it allow all of the interest to be deductible, or does it limit how much interest is deductible?
This is the
Thin capitalization, yeah. So the 163J. Yeah, I think, I would say generally, in some of the courses, there's a tendency to tell you about the tax law, but not necessarily force you to look at it and read it. Some courses are taught, telling you to look at a textbook as opposed to the law itself. My experience is that 90 to 95% of your answers come right out of the law. And it's always much better to familiarize yourself with the law itself. It may be the first time you look at it miserable to read, but you're generally going to be better off reading the law, and then secondly, reading some textbook or other thing that talks about what the law is.